Welcome back everyone and good afternoon. You're watching Closing Bell and I'm Santosh Nair. Well, it's been a strong start to the year. The Nifty once again trying to get past the crucial resistance mark of 18,200, but on the whole, both indices have been able to build on the early morning gains. And more than the front line shares, it's the second line shares which are doing really well at this point in time. The NSE mid cap and NSE small cap indices are up by close to about 1% each. Metal stocks are among the star performers of the day. The metal index is up by about close to 2.5%, and 14 out of 15 stocks in the index are trading higher at this point in time. And among the underperforming sectors, shares from the FMCG and pharma sector are under pressure at this point. Well, but the focus clearly is on metal shares. They have been rising right from the start of today's trading session, and to make sense of the rally in metal shares, we are now joined by Nandish Shah, who is an analyst with Moneycontrol Pro. Nandish, good to have you here with us.
Thanks for having me.
Well, so Nandish, what do you make of this sudden interest for metal shares? Still about a week back, these shares were just about doing okay, but all of a sudden today there seems to be huge appetite. So what's driving this interest?
See, basically, there are a couple of reasons for the metal prices to move higher. In the December quarter, we had seen a subdued demand for steel, especially due to the extended monsoon. Now, with the fourth quarter coming into picture, especially the March quarter, which is usually what is a busy period for construction and infra companies, and so the market expects higher volumes of metals going forward.
There's also this report by Jefferies in which it has upgraded some of the key stocks, Tata Steel and Hindalco notably. So Nandish, do you think that is also driving sentiment at this point in time?
Yeah, that can. I guess even with Jeffries, what is a couple of brokerage have again come up with a buy report on metals.
And one of the points which the Jefferies report mentioned is that opening of Chinese economy with the curbs, the COVID restrictions now easing, and also the government expected to provide incentives for the realty sector. Probably demand is going to go up. There's going to be more construction. But also tell us, Nandish, isn't it also a fact that when the Chinese economy is doing good at that point in time, it also exports a lot of metal. So at a net level, how does it work for steel and aluminum prices?
See, in last 2 years, we have seen there's a production from China to be stable to flattish. Plus, there has been lot of environmental restrictions which have been put in place by the Chinese government to control pollutions in China. So, even the world expects that China will report a flattish production numbers for even for CY23, or we can even witness a decline in CY23 for steel.
So Nandish,
Secondly,
sorry,
with the yeah, sorry.
no, please go on, go on.
Yeah, with Chinese opening economy opening up, we expect what is the demand for steel to be consumed domestically rather than more export is what is likely to be restricted.
Okay, but what about the overall global scenario? Because right now, the talk, or rather the expectations, is that US could most likely tip into a recession, even if it's a shallow recession. We're seeing signs of slowdown in eurozone as well. Now, broadly, what does slowdown in both US and Europe mean for steel and aluminium stocks?
In case the Western world goes into a recession or even for a mild slowdown, it can impact steel. But when it comes to a production order, Chinese is, I guess, one of the largest producer and consumer of steel, and second largest in terms of steel production currently stands with India. India, I guess, around capacity of 150 to 170 million tons, and the consumption locally is around 110 million tons. So we are still left with about 50 to 60 million tons incremental capacity, which we can export. Plus, in terms of Western world, has seen a lot of pressure in terms of cost push, which has led to lower margins for steel. Which again, where India comes into picture, where they can fill up the gap and start export. Plus, recently, Indian government has abolished export duty which will again provide an incentive to export more steel outside India.
And what are broadly the domestic trends been? Some reports say that even locally stocks are steel prices are still at a slight premium to export prices.
I don't think so. We are at a slight premium. We last when we had checked, it was what is it, trading at a premium. Currently, it must be at a slight premium, but when it comes to import, it is not viable at these prices to continue.
Okay, and what's your outlook as far as the margins go? Because what hurt steel companies over the last couple of quarters have also been high raw material prices. Now, what is the trend as far as raw material prices go?
Raw price, yeah, in terms of raw material prices, we have recently seen that iron ore prices have started increasing. We had seen about $90 per ton for iron ore, which and currently iron ore prices is around 110 per ton. So basically, the steel prices has also catched up. Looking at the raw material price trends. Even in that matter for coking coal saw a low of about $220 per ton, and currently is around $250 per ton. So even higher raw material prices has given an what is a push in terms of prices for steel.
And how is this likely to impact probably the third quarter numbers of steel companies? What are you looking at? Will the
So
performance be in line with market expectations, better than market expectations? How is it going to be like?
So when we had analyzed the December numbers on a what you say rough cut basis, we expect that the margins are likely to recover in the December quarter compared to the September 22 quarter, especially because uh, these companies had a coking coal consumption rate of about $250 per ton in December, as compared to a coking coal rate of about what is a $325 per ton. So that will lead to an increase in margins on a sequential basis for majority of the steel companies.
So, Nandish, tell us about your views on the major steel companies, Tata Steel, GSW Steel, and also Steel Authority, if you're tracking that.
Yeah. Uh, when it comes to preference in terms of what is a steel stock, I would my first preference would be JSW Steel. See, JSW has recently put up a capacity of 5 million tons in Dolvi, and they have started ramping it up. So once the local demand for steel or even for export of steel demand picks up, JSW Steel is likely to be the what is the biggest beneficiary of higher volumes going forward. In terms of second preference, it would be what is a Jindal Steel and Power and Tata Steel put together. Tata Steel would be on a second list, despite being integrated play, is because of the overhang it has with in terms to its European operations for us.
And what about the last one? Do you track Steel Authority of India
Yeah,
sales?
I track Steel Authority, but that would come in the last because in terms of sale, their bigger overhang is what is a lower production and higher employee cost, which leads to lower EBITDA per ton as compared to other steel peers.
And what's your view on the aluminium sector, Nandish? So, for instance, Hindalco and Nalco, how are those stocks looking, especially after the recent rally? Both those stocks have rallied quite a bit from the lows which were seen in April and are almost now somewhere in the region of making fresh highs again. So, how do these stocks look?
See, aluminum prices corrected from, I guess they touched a low of around $2,100 per ton in LME, and currently they are trading at around $2,400 per ton. So when we look at the global cost curve, about 50% of the Chinese manufacturer of primary aluminum have started making losses because of higher raw material prices and very depressed LME prices. Also, we are staring at one of the lowest LME inventories of aluminum. So from here on, we expect aluminum prices to remain stable, or it can touch upward higher levels. In terms of stock preference, we continue to rank Hindalco compared to Nalco, because nearly about 60 to 65% of Hindalco earnings come from Novelis, which is much more stable business, and also the exposure to commodity prices reduces.
But Novelis did make a profit warning of sorts, right, recently.
Yeah,
Does that affect the outlook for Hindalco?
they have already given a profit warning for Q3 and Q4 about Novelis. So I guess the stock price must have discounted that news. But what is say going forward, in terms of stability of earnings, Hindalco will be much more preferred compared to Nalco.
Well, thank you, Nandish, so much for joining us and sharing those insights with our viewers.
Thanks a lot.
And before we wrap up this edition of Closing Bell, a quick check on the market, and the Nifty is up by close to about 86 points at this point in time at 18,191. It's been struggling to get past 18,200, and the level that technical analysts are watching on the higher side is 18,261, which is the 50-day moving average, and on the lower end it is 17,878, which is the 100-day moving average and also seen as a key support level for the index. Mid cap and small caps too continue to do well at this point. And well, that's all that we have in this episode of Closing Bell. Thank you for watching, and we'll be back with you again at 9 a.m. tomorrow. In the meantime, for all news, views and analysis, stay logged on to moneycontrol.com.